and kick things off to the close here with Catherine Avery, CEO and president of Catherine Avery Investment Management. And Catherine, let's start off here, not with the nonsense going on in Washington or some of the geopolitical issues, but earnings season, which I thought was supposed to be the salve for this market. The idea that if we didn't necessarily get a lot of sort of bright spots out of those 3Q numbers, at the very least, we might get some signals that the earnings trough was in. I know it's still early, but have you been encouraged?
Actually, very encouraged. And Romaine, thank you. And Katie, thank you for having me. I think next week we really get into the thick of it when it comes to earnings. And for the third quarter, we're expecting probably anywhere between flat to slightly positive single digits, year over year positive earnings growth. And if you take out the energy numbers, it looks even better for the S&P 500. But I think that's going to give people a lot of encouragement going forward. You know, 2024, we're looking at a 12% year over year growth for the S&P 500, and it's only going to get better going into the fourth quarter. I think a lot of stocks are starting to see that the pricing pressures are starting to ease off. We're going to start to see some better profit margins going forward as inflation has started to ease.
What's actually moving this market right now, Catherine? Is the focus really on earnings, or is it still on the Fed and interest rates?
Right now, it's on the Fed and the interest rates. You know, the steepening of the yield curve, which has actually been, it's kind of nice to see, because you want a steeper yield curve. It takes away a lot of those recession fears that we were having before, which is somewhat positive. But right now, it's a lot of the supply that's being rolled off from the Fed's balance sheet that's not being readily absorbed. And look, I look at it this way, you know, if the market does the job of the Fed, then maybe we can sit back and say that the Fed has definitely paused and is ready to sit back and take a wait-and-see attitude.
But Catherine, is that maybe be careful what you wish for a situation? When you think about potentially the bond market doing the work for the Fed, sure, you can look at the rise in yields that we've seen thus far and make that conclusion. But at what point does that turn more hurtful than it has been helpful?
Yeah, I think at some point the market will tell you enough on the rates. And I think the market could probably handle a 5% 10-year, but as we get north of that 5% rate, I think it gets a little tough for certain companies. But, you know, in anything, you have to look at, you know, well, if this is what the market's given us, well, where do we go? And you want to look at towards those companies that are not dependent upon the debt markets to grow their businesses. So something that's quality, cash rich, has a dividend yield where they're returning money back to shareholders.
And talk to us a little bit more about what companies that excludes. When you think about, you know, a sector, an industry level, what are the companies that maybe you would exclude from your overweight positions right now?
I would be a little bit careful of the financials. They're going to have some headwinds with the rates going up. I mean, that's usually not normal. Usually when the interest rates go up, their net interest margins expand. But now we're at a time where it's going to hurt their capital requirements. Consumer is another place that would really be leery, anything consumer related. Whereas consumers, if they start to take on more debt, that's going to impact their ability to spend more.
When we get to this idea here, Catherine, the idea that the market is waiting for, I guess, a little bit more of a baseline, and knowing that not only are corporate fundamentals relatively healthy, but the economy has sort of reached some sort of threshold that people can be comfortable with here. Do you think that that also means that we have to get comfortable with a 5% or whatever that neutral rate ends up being with the Fed, that is more or less here to stay, barring a recession that would cause them to cut rates?
Yeah. Well, you know, Romaine, 5% is really not abnormal. It was the 0% interest rates that we had after the great financial crisis that was abnormal. So a lot of this is really just getting back to a normalcy into the yield curve. And so I think that that the market has the ability to absorb that, has the ability to grow in that phase. And again, you know, focus on, as we said, the areas to avoid, but how about the areas to focus on? Let's follow that money. Where is the money going? Where is capital moving into? And if you take a look at the fiscal policy, it's all about infrastructure and onshoring. So looking at companies that are industrial, bringing manufacturing back here in the U.S., material companies. Again, looking at companies that are involved in artificial intelligence, technology companies that may not have the higher valuations, but those that are the staple technology companies that are involved in the ecosystem of artificial intelligence, that have that strong cash flow, returning capital back to investors, and have those lower valuations. So that's where we're seeing a lot of money being deployed. And then lastly, the energy sector. We're depleting our supplies of oil here in the U.S. and strategic reserves. And we have this disruption over in the Middle East. OPEC has cut production. We're seeing that the commodity price is now over $90 for crude. It's probably that we're going to see the base of that commodity price in the $80 to $100 range, as opposed to a $60 to $80 range. So that's going to be good for these companies.
All right, Catherine, great stuff. Going to have to leave it there. Catherine Avery, CEO and President over at Catherine Avery Investment Management. Decades of experience there. Our thanks to her as we kick